Hi, Nevin. My name is Ying Chan. It's very nice to meet you. My research startup has been independently developing a solution to debt crises, decentralized solution. And my question is this: Has really hyperinflation is really only a symptom that appears at the end of a long-term debt cycle? That is, money printing is not really the key issue, but that central banks tend to trend a risk-free interest rate down to zero over multiple business cycles. So my high-level question is, why is it that Reserve has just focused on the supply of money rather than on a counter-cyclical risk-free interest rate?
Well, it's a good question. So I agree that hyperinflation is sort of a symptom rather than a cause. And like in some of the countries that we do work in, the way that we think about it is like, you see the situation where an economy is dependent on just one main export, and then if that export stops being valuable to the world, for example, oil is kind of a common case here, you suddenly stop having a lot of inflow of essentially demand for the local currency, and that can be sort of a key fiscal problem that ends up leading to monetization of that debt in the form of hyperinflation. The way we think about it is that in the short term, what we're doing right now with just having tokenized US dollars on chain, essentially, we're not stopping hyperinflation. We're just offering a tool for people to cope with that situation once it already exists. And so our work today really is just helping people cope with hyperinflation, not do anything to defeat it. In the long term, the objective is to have a currency that is asset backed, that basically doesn't really have any independent monetary policy at all. So there wouldn't be control of interest rates, because it's basically a pegged currency. But in this case, it's pegged not to another fiat currency. The idea is to eventually have a currency that's pegged to a basket of assets that are out of the control of any government or treasury or central bank. And essentially, it's a sort of more technological take on something that's more like commodity money. And so you give up control of monetary policy in the same way by doing that, but you basically create a currency that, and the idea is kind of like how anyone can look at Bitcoin and not have to trust any particular party to keep the number of coins at 21 million. The idea here is that you could look at this system and analyze it and not have to trust any particular party, to basically keep that commitment of the currency being backed by that slowly evolving decentralized basket of assets. And so I don't know that like perfectly addresses exactly the economic concept that you brought to bear there. And if we had more time, I'd be interested to talk about that. But basically, our take is pretty, it's almost intentionally rudimentary. We're not trying to create an on-chain protocol that does anything nearly as complicated as the Fed or any central bank would do in terms of controlling those things. We're really just creating a simple protocol for creating an asset-backed currency, with a basket, so that you get basically the behavior of like a currency peg or a currency board, if you're familiar with those concepts.
Yeah, okay, no, that sounds completely reasonable. So what I guess the long-term vision is that there would be a different basket of goods per currency, or else I guess you'll suffer from the same problems as like gold standard, where like some country which has a local domestic crisis can't really stimulate the economy because they can't just adjust their interest rate or print more money.
That's right. So basically, if this currency that we're proposing does get used on a massive scale, it does mean that the countries using it don't really have the ability to stimulate their economy in that way. And this is the same sort of situation that a country gets into if they dollarize, if they use the U.S. dollar when they're not in control of the U.S. dollar. So there's several countries, including in Latin America, that use the U.S. dollar as their primary currency because they ended up concluding, okay, it's actually better to have the stability and not take the risk, of currency issues, even though we're giving up control of monetary policy and we don't really have the tools to steer the economy in quite the sophisticated way that, say, the US does.
Yeah, interesting. So yeah, that's interesting that you point that out because that's very much in line with the sort of independent solution that we've been developing. With ours has like the extra facet where maybe you would give like a country so-called national Bitcoin so that they still have some form of option to slowly print money if they so choose to. But maybe you can put some limits, some constraints on how much they can do that per year or something.
Cool, cool. Well, if you send me a DM, I'd be curious to learn more. And I think this is that was a good question, a good introduction for the overall framing. I want to especially focus today on the mechanics of the new proto. So for folks, especially folks who've taken the time to read the recently published high-level documentation, if you have clarification questions or questions about things that we didn't cover in that documentation, I'm excited to be asked about any of those details and talk about the protocol on a mechanistic level.
All right.
Yep,
Thank you, John. I'm gonna repeat this just one more time. If you want to ask a question, you can just use the request as speaker function. You can also use the emoji, the hands up emoji, but I'm not seeing any hands up just yet, so I'm not sure if that's a problem on my end or something else. So if you could use the request speaker function, that's something that I do see. So let's bring the next person in.
Hello.
Hello.
Hi guys, how are you?
Good, good.
Guys, I'm kind of new at all of this stuff. I just started like a couple of months ago, and about RSR, like what does it do exactly? If you don't mind explaining, I would truly appreciate it.
Sure. So RSR on a fundamental level is a token that participants can use to provide insurance, to basically provide an ultimate backstop for the reserve protocol for any given reserve stablecoin. And in exchange, RSR holders, when they provide that backstop, they're taking on some amount of economic risk. They also stand to gain from that. So they can earn a portion of the revenue that any particular reserve stablecoin generates. So the way to think about it is that reserve rights holders are kind of like a decentralized insurance body. It's not really the same as insurance, and maybe I shouldn't even use the word insurance. Maybe our general counsel would be mad if he heard me using the word insurance. So like, we're not sort of standing up and saying this is a legal guarantee of insurance or anything like that. But if you look at the economics of the protocol, it is a similar concept where if one of the tokens that's in the basket that backs a reserve stablecoin actually defaults, like it has some technical problem, or if it's asset backed, the issuer, if they don't have enough funds to back it or something like that, then basically the reserve rights token holders will have taken on risk and basically will be willing to give up their own capital to cover the stablecoin, to make it so that the stablecoin holders don't lose money, or at least don't lose as much money. And again, in exchange, they earn a portion of revenue that instead of going to the stablecoin holders goes to them instead. So it's a little bit like the stablecoin holders are making like a periodic, payout, like a sort of periodic. Trying to think about what you would call it if it was an insurance plan. There's probably a basic term here. If you'd be paying a premium, right? So it's like the stablecoin holders are consistently paying a premium, and then every once in a while, if something bad were to happen, then that decentralized insurance body covers it. So that's the basic function of RSR. Yeah.
Okay, so when you say stable, you mean USD and US Tether and stuff like that, or?
So the reserve protocol, the way that it works, it allows people to create stablecoins that are backed by differing baskets. So today we have a stablecoin that's backed just by US dollar stablecoins, USDC, TrueUSD, and Paxos. The next thing that we'll be deploying, as we've discussed, is backed by similar to US dollar stablecoins, but basically tokens that come out of DeFi that are sort of like US dollars with yield baked in because they come from Compound and Aave and elsewhere. But the protocol is generic. It allows you to create baskets that contain many different tokens. And so that, like we were just speaking about with the last question, the eventual goal is to have a stablecoin that's backed by a basket of tokenized assets that aren't US dollars. Tokenized gold is like the one example where it already exists on chain, but we believe that other commodities will be tokenized over the course of time, and that you'll be able to create something that is independent of fiat currency.
Cool. So in other words, it's protecting the holders of the other coins.
That is, yes, that is sort of what the RSR holders are doing. Yep.
Very good. Well, you know what? Thank you so much for all that information. I do appreciate it, bro.
Yep, you're welcome.
Thanks, Nevin. All right, let's bring on the next person.
Hi, Nevin. Hi, everyone. How are you doing?
Hey, how's
I'm
it going?
good. I have a couple of questions, one regarding staking and one regarding the updates. One, the white paper. When are we expecting to see an updated white paper on the new protocol or the updated protocol? And regarding staking, do you have envisage or do you have a plan already to where the staking rewards go to? Is it Compound or does it go into a separate wallet?
Got it. Let me ask, I'm going to answer that second one first. So when you stake RSR and you earn staking rewards, the way that we're currently coding it, your staked RSR balance will just increase. So it'll be automatically added to your staked RSR balance. And then to answer your first question, well, I mean, we're here today to discuss the high-level documentation that we posted on the website. So that's the first step in posting the public documentation for the new protocol. The further, like much more granular documentation that will end up being posted will be a little bit different from our prior white paper. In a sense, our prior white paper was actually also relatively high level. Because this time we are implementing everything fully in Solidity, there will be much more specific documentation that will actually go down to the level of describing different functions and how they work and how they interact. I'm not sure exactly when that's going to be published, but it's going to be published before the launch of the protocol, because we will need to get to the point of the code being fully implemented and that documentation being fully complete in order to hand those to external auditors prior to the actual mainnet launch. So you'll see that sometime in the coming months.
Okay, thank you. Thanks, Evan.
Yeah.
All right. Before we bring on the next person, I got a message that some people can't request as a speaker since they're joining from desktop. So, but it's also an option is if you have a question for Nevin and you can't request as a speaker, you can also reply to the Twitter Spaces tweet, and then I'll just read your question for Nevin. So let's bring on the next person. Faizan, are you here? He's connecting, I see. Well, Faizan, if you can hear us, I'll just remove you for just a second, and I'll bring you back after. Just request as a speaker again.
One thing I'll add while we're waiting is I see some core team members on the call. Feel free to also ask questions while we're here. Like, I know that this is meant for the broader community as well, but don't hesitate to jump in and ask questions if you have them.
Ravi, are you here?
Yes, I am. Can you hear me?
Yes.
Yep.
Yep. I have a couple of questions actually. Again, I've just got into RSR recently, so I'm just doing my due diligence. So I thought this would be an amazing opportunity for me to better understand the protocol from the founder himself. So my first question is actually, I was going through RSR and RSV. Can you just explain what is RSV like? For example, what's the difference between algorithmic back stablecoin and RSV? Because I'm having a bit of a trouble, me as a bit of a novice, understanding that. So if you could just explain in kind of a simple term, so that would really help me.
Sure. So in general, I mean, there's different designs for algorithmic stablecoins, but the general idea behind an algorithmic stablecoin is that you have a protocol that somehow manipulates the supply of the stablecoin, but in a non-traditional way. Like it's not using. I mean, you kind of have to understand the traditional way of doing this for that to make sense. So the traditional way that you manipulate the supply of a currency, if you're trying to stabilize it against something else, like the U.S. dollar, or as we've been talking about, like a basket of assets, is you operate what's called a currency board. And the way a currency board works is, let's say I'm operating the currency board, and you, Ravi, you want to issue a new unit of that currency. You have to come to me and say, okay, here's some of the assets that you back that currency with. Now give me some newly minted units of that currency, and we maintain a fixed relation between that. So, like, this is how normal dollar stablecoins work. You have to basically deposit a dollar, like, wire a dollar to Circle in order to get a USDC token, for example. And what that does is it makes it so that anytime Circle wants to, they can repurchase those tokens out of circulation for the dollars or whatever it is that they're holding underneath, because they always have that full 100% backing. An algorithmic approach is an approach where you somehow, without full backing, either you have no backing or maybe you have partial backing, you try to invent some other financial instrument that allows you to purchase tokens out of circulation in the event that the token has gone below the price that it's supposed to be maintained at. And so a common strategy there is to create something that's like a bond or some sort of like debt instrument, where it's like, okay, we'll create this other token, and we'll use it to purchase the stablecoin out of circulation if somebody wants to redeem the stablecoin. And what is this other token? Well, this other token has some value that's somehow based on the protocol. Maybe the protocol has fees, and so it'll generate revenue, and over the course of time, maybe you'll get a portion of those fees, or maybe you can use that token to buy back, to purchase newly minted stablecoins when demand goes up. There's all sorts of different schemes. We thought about, we tried really hard to come up with an algorithmic stablecoin design that makes sense, because there's a big advantage in terms of capital efficiency. And ultimately, we concluded that it's pretty unsafe to do that, because you just really can't reason very, very clearly and very simply about the possible scenarios where you end up not being able to purchase tokens out of circulation. And if that happens, you could have a crash in a stablecoin. And this has happened before with algorithmic stablecoins that have existed. One case that I think was useful and educational for the space is that even though Basis didn't launch, another team copied the Basis protocol and went ahead and launched it. And you can go read about the results for yourself, but it ended up crashing and burning pretty much as expected. And so, I worry about this with other more prominent algorithmic stablecoins as well. And so the difference between Reserve and those is that we just take a more conservative approach, where the token is always fully backed by the assets that it's meant to be redeemable for. So you just don't really have any economic guesswork involved. So that's kind of there's nuance there. There's probably more that you would want to understand if you want to fully get that, but that's sort of the summary.
Perfect. Just one last one. So, I was just, again, doing my research and everything. Most of the stable coins which are being launched are these algorithmic backed stable coins. So is it safe to say that it's the most easiest way to launch a stable coin, and the way you guys are doing it, it's a more difficult one and a slower process?
Not necessarily. you could have algorithmic stablecoins that are even more complicated and harder to launch than Reserve. I think, though, that there's something intoxicating about algorithmic stablecoins, which is that you sort of get money coming out of nowhere. And so when you have money coming out of nowhere, then there's always a possibility that you can somehow make a lot of investors or the founders very rich. And so I think there tends to be, crypto is generally an industry, crypto circa, 2017 through 2021 at least, is certainly an industry that's very focused on making instant money. And so algorithmic stablecoins present, an alluring opportunity to try to sort of find a way to print money out of nothing. It's sort of actually, it's like the thing that we in crypto tend to complain about, the central banks doing. People say it's bad because there's money being printed and the bankers are just like getting free money and whatever. That's sort of true and not true in various different ways. Well, I mean, the people who are creating algorithmic stablecoins are kind of trying to do the same thing. It's just sort of a way to make money, I think.
Perfect. Thank you so much for your answers, Nevin.
Yeah. And again, I want to emphasize, let's try to prioritize questions that are coming from people who've read the recently published documentation that we posted on Twitter, and have follow-up questions on that. Because I really want to try to. The goal of this is really to help the community deepen its understanding of this updated protocol. The people who are on this call are some of the people who are most involved in the community, and I want to make sure that those people are educated so they can answer further questions in an ongoing way and help with sort of a broader education effort.
And to jump in on that, Nevin, we were getting some questions on the Twitter post, which is relevant on what you just said. There's a user here asking. So he read the new documentation, and he read about the staking, and he's asking, how will staking work with tokens stored on cold storages like Ledger and Trezor? Will they be able to stake directly from those wallets, or how would that look?
That's a good question. So, so the way that staking works, you would have to have access to. So let's say that you have RSR tokens held with a Ledger hardware wallet. You would have to have access to that Ledger hardware wallet in order to make the deposit transaction to stake the RSR. But then once you had done that, what happens is actually the protocol issues you tokens that basically represent your staked RSR balance. So now, instead of holding RSR with that Ledger wallet, you're now holding these tokens that are sort of, it's a little bit like when you deposit USDC into Compound and you get CUSDC, which is a token that sort of represents your balance on Compound, and you can redeem it later for USDC plus some yield. It's a very similar pattern here where you will get a token. We haven't named this yet, but you'll get a token that represents that staked RSR balance, and you'll now have that balance on that ledger, and then you can just leave it there. So you hold that balance. You could also transfer that balance to someone else if you wanted to, or trade it on a DEX. But by default, yeah, you could just hold that in cold storage. And as long as you don't want to adjust your staked position, as long as you don't want to make a decision and decide, okay, I actually want to go stake on this other RToken instead, then you could just leave that in cold storage, and you would continue to earn staking rewards by doing that.
All right, thank you so much. Let's bring in the next person. Abu Crypto, I invited you, if you can see the invite. And if not, then we'll try the next person.
Oh, hey everyone. Okay, so my question was, are there any plans to onboard like real-world assets for collateral, similar to what MakerDAO's been doing? So things like real estate and other tangible assets, or even more obscure things like music royalties or like artwork or any other kind of thing that could be tokenized?
Yeah. Hi. So the answer is, in the long term, yes. The goal is to have RTokens, basically reserve stablecoins that are backed by baskets of real-world assets that are not fiat currencies. I don't anticipate. Well, okay. Let me put it this way: the RTokens that I'm personally excited about wouldn't be backed by very obscure things like art or music royalties, because I would anticipate that those assets would be relatively volatile. And the way that the reserve protocol works is that the stablecoin is essentially directly inheriting the value of the assets that are backing it. Whereas with MakerDAO, for instance, each individual CDP holder is really the main holder of that collateral asset, and that volatility isn't really passed on directly to DAI. So in this case, we anticipate real-world assets that are selected for their relative stability. And so, like I said before, tokenized gold is an example of something that's already on chain that I do anticipate will be included in future RToken baskets. And our belief is that other relatively stable commodities will end up being tokenized over the course of time, and we'll aggregate those together into baskets. Now, I should say that part of the way that we're designing the reserve protocol is to make it fully open for anyone to deploy a new RToken and choose what its initial basket is, and also choose how the governance system that governs that RToken works. So, we as a core team will create some RTokens and we'll select, how governance will work for those. And then over the course of time, those governing bodies can make decisions about how to change those RTokens in terms of the baskets and even the governance protocol itself. But it's also the case that other people can and probably will deploy different RTokens that are backed by different sorts of things. So someone could create an RToken that's backed by tokenized art or music royalties or anything else that exists on Ethereum. We are based on Ethereum, so unless somebody deploys the protocol to another layer 1 blockchain, it would come down to what exists on Ethereum. But we intentionally opened it up, and we will, over the course of time, try to encourage others to create RTokens, because we think that it's a bad idea in the long term for the exploration to be bounded by what we, or even the governors of RTokens, whoever they may be, depending on whatever governance protocols they are, to be fully in control. Like, we like the idea of, if somebody else thinks, well, there should be a token with this other basket, and no current RToken governance bodies are willing to do that, fine, then just go create it and see if people want that. So that's sort of the idea with the open competition aspect of how the RToken system is going to work. That's sort of the point of it.
Awesome. Thank you so much for your answer. Bye.
Yeah.
All right, let's bring up the next person. Yes.
When you stake RSR, you receive tokens that represent your stake position. Why does the team prefer that the stakers receive a quantity of tokens versus maybe an ERC-721, similar to a Uniswap LP token representing the stake position? What more can you tell us about the mechanism and its features and possible tax implications in different markets?
Tax implications, it's a good question. We have not carefully thought through what this will mean for people's taxation, because we've been focused more on the actual underlying mechanism. But it is something that's worth thinking about. And I could even imagine that some RTokens end up evolving to actually be sensitive to taxation over the course of time. The reason why we are initially deploying the RToken to to work that way where the tokenized balance is well, okay. How do I put this? The simple answer is fungibility, right? So if you have a token that's non-transferable, or a token that represents like a particular sized stake, even if it is transferable, then you don't have fungibility of those staked positions. And we thought it through and realized that sort of regardless of how we initially program it, it would be possible for other smart contracts to be created that would allow you to basically stake your RSR at one layer of removal and get that same property of fungibility. Like basically, even if we didn't want the balances tokenized, it would be possible to tokenize them. And if this staking gets popular, we believe that they would end up being tokenized. So we decided, okay, we may as well just build the tokenization directly into the protocol. If you have it set up so that those staked RSR balances are fungible token, basically fungible token balances that are essentially ERC20 tokens, it makes it so that any other DeFi protocol can use those tokens. So it means that like you could have a staked RSR balance, and then you could go deposit that somewhere else as collateral for like another loan that you want to take. And so basically, it means that the reserve protocol functions as, as we like to say, sort of like a DeFi Lego or a DeFi building block. It's now the case that that staked RSR balance can be repurposed and used in different ways. And so we believe that will likely open up utility and opportunities for RSR stakers over the course of time. We don't have anything specific in mind. This is just like a basic functionality, making it so that others in the DeFi space can easily program on top of it by using, allowing people to use their staked RSR balances. It also makes it so that as an RSR staker, if you want to exit that staked position, even though there was a delay in withdrawing your staked RSR and actually ending up with raw RSR again, and that delay has to be there because it needs to be that RSR can't be withdrawn in the case of a default. If everybody could just withdraw their RSR immediately, then effectively that insurance mechanism wouldn't work. So there has to be a delay there. But if the staked RSR position itself is transferable, then it gives you liquidity. It gives you the opportunity to exit that position quickly if you want to. And obviously, I'm in favor of people not exiting those positions. The whole point is to design the protocol so that it's attractive to hold those positions over the course of time. But I'm also a believer that when you try to box people in, like if you try to stop people from exiting, that actually stops people from entering as well. Like we saw this with, for example, I think like a really good example of this was the Gemini dollar. When the Gemini dollar was initially launched, there was sort of like a penalty for redeeming. And when there's a penalty for redeeming a stablecoin, it's less attractive to mint that stablecoin and to use that stablecoin. People don't want to be locked in. And we see this similarly with capital controls. In some of the countries that we deal with, we see that when you institute capital controls, that actually causes more people to want to exit the currency. The currency becomes less valuable because it's more restricted. So in the same way, we wanted to make it so that a staked RSR balance is sort of as free and liquid as it can be, while still maintaining that property of making it so you can't withdraw the underlying RSR without a delay, because that's economically necessary for the protocol. So by tokenizing the balance and making it so that you can actually, you could go trade that tokenized balance on a DEX, or go use it as collateral in some other DeFi protocol. We believe that will actually make staking more attractive and more, higher utility to RSR holders.
Okay. Is there any way you could tell us more about the mechanism in the case of a default whereby your staked RSR position is seized pro rata? This is the part I'm trying to understand. How do we get affected immediately?
Yep, it's a great question. So let's see. I'm going to try to make up a simple example. And this could get complicated, but hopefully this will be helpful. So let's say that we have an R token that has a basket that has 4 different assets in it. Okay, and then let's say that one of those assets defaults. So let's say they're equal quantities and equal values. So let's say 25% of the backing of the R token is lost because that token defaults. And again, like, I think it's important to mention whenever talking about this mechanism that the tokens that will back these R tokens in general will be pretty safe and pretty stable. So it's really not expected that any of them would default. And if they do, it would be a very sort of unlikely surprise black swan type situation, but it's possible, right? And that's the whole point of baking in this insurance mechanism. So let's say that it happens. And let's just say that there's only, like, let's just use dollar terms because that's easy to think about. Let's say one R token is worth $1. And let's say that there's only 100 R tokens of this type in existence. So the entire circulating supply is just $100 worth. And 1/4 of that has defaulted. So we've lost $25 in value from that collateral token defaulting. So what that means is that the R token is now $25 undercapitalized. And so in that scenario, what needs to happen is the protocol, the way that it's going to respond is, this will be flagged. It will recognize this with price feeds. And then what will happen is that collateral token that has defaulted is going to be replaced with a backup collateral token that's basically pre-designated by the set of backup baskets that governance has already specified in advance. So basically, the protocol will deterministically be able to tell, okay, this token that has just gone to 0 or defaulted to some extent is going to be replaced by this other token that's part of sort of the next relevant basket in line. Now, where does that, how does that happen? It's like, okay, we have $75 in collateral value. We need $100 in collateral value again. That's where the seizure of RSR comes in. So the staked RSR, and again, only RSR that's staked on that particular R token is subject to this. So if you thought that that was a risky R token and you didn't stake on it, your RSR wouldn't be affected in this situation. Your RSR only gets affected here if you have chosen to stake on that particular R token. And if you've done that, you've been earning revenue probably for quite a long time before a default would happen. But at that point, that R token can then basically seize, and here's where that term you mentioned comes in. It can seize pro rata the RSR that's been staked. What does pro rata mean? It means that, let's say I've staked 5 RSR and you've staked 10 RSR. Well, I'll be getting half as much revenue every period as you will be because you've staked twice as much. But when the RSR gets seized, twice as much will be seized from you as will be from me. So pro rata just means sort of like in keeping with, proportional to everybody's positions, proportional to how much everybody has staked. So if you staked twice as much, then twice as much will be seized from you, but also you would have been getting twice as much as revenue of the revenue over the course of time. So basically the protocol will seize RSR and use that RSR. It'll go trade that RSR on DEXs in order to purchase the new collateral asset that it needs to purchase to recapitalize the R token. So that is the sort of insurance payout scenario where the RSR holders get sort of billed in order to make up for a default. And that's what I mean by pro rata. Does that make sense? If you have any follow-up questions on that, please go ahead and ask them.
That totally makes sense to me. Thank you.
Yeah, you're welcome.
All right, Robin, I've already made you a speaker. Go ahead.
Hi there. So if anyone can create an R token, and I'm trying to get my head around it to explain it to my grandmother, because she said to me, she said, this is really complex, Jim, and I'd really love to understand this. So are you looking for things like BlockFi or Celsius or Coinbase or Grayscale to come in and create R tokens? or I'm just trying to get a handle on the type of organization that you want to partner with to create them. And the second part is what money, what capital do they have to put in terms of buying a basket of assets so that they're backed by RSR?
Okay, I understood the first question. I didn't quite understand the second one, but we'll get that in a minute. So when we decided to turn the protocol into more of a platform and encourage people to create RTokens, we didn't have like institutions or other companies in mind. So the main goal of this is just to make it so that really any individual, any team, any sort of group of crypto developers or enthusiasts can create an RToken just like us, right? We don't have anything special to our names. We're just people who have ideas about what would be useful for a currency. And so the idea is to make it so that anybody who has an idea that they think is a good idea for how a basket-backed currency could work can easily go and deploy it. And so that's similar to how, like with Uniswap, anybody can deploy a trading pair on Uniswap. You don't have to, be good at promoting it. You don't have to, have any credibility or anything. Nobody even really knows who created most Uniswap pairs. However, it may be attractive for like a fintech company or an exchange or or I don't know, a bank or whatever financial entities or companies that have large user bases that want to add like a sort of fintech element to their business to create an RToken that's essentially their branded stablecoin and then offer that to their users. So that could happen, but that wasn't the original intent. And if companies express interest in doing that, we'll certainly be very happy to walk them through the technical details and help them decide how to do it. And it is the case that we programmed the RToken design to basically make it so that you can arbitrarily assign revenue streams. So if the RToken generates revenue, then we expect a portion of that to be allocated to RSR stakers to incentivize RSR holders to stake so that RToken has insurance. But you could, as like a fintech company, you could create an RToken, offer it to your users, and then direct 10% or 20% of the revenue to your company. You'd have to think about the legal implications of doing that in whatever jurisdiction you're operating in. So there's like sort of some legal questions about whether that would be attractive or feasible. But assuming that it is, that could be an interesting model for a fintech company because, as a fintech company, you might not have a whole like blockchain department. You might not have, the expertise that like we've built over the course of several years on the Reserve project, or that a really, really deep crypto project ends up having to have. You'd be able to actually deploy an RToken relatively safely and operate it relatively safely without quite as much of that investment. So that's one reason why it could end up being attractive on that level. But like I said at the beginning, that wasn't the original intent. And if that doesn't happen, like that'll be fine. It's not, the plan doesn't really depend on that happening. And could you go ahead and repeat that second question?
So the second part, thanks for that. The second part of the question was, so let's say someone creates an RToken and they're looking for 1,000 RSR as, call it insurance or whatever, to back it up. Do they need to put anything in? So in terms of the basket of assets that they decide to collateralize it against, do they need to have skin in the game, or is the RSR is it where the money and the collateral comes from? And I see it as, I could be wrong, Nevin, I see it as two sides of an equation. So one side is the token, the RToken that needs that is offering something that has a value based on something it owns, and how does it buy that to own it? And the second side of the other side of the equation is the RSR backing that up.
Yeah, so you can create an RToken and deploy it without depositing any capital yourself. You basically have created a system that says, if anyone wants to come create this RToken, here's the basket that they need to deposit in order to mint mint this R token. And so you've just defined the rules to the game, so to speak. And then anyone at that point, permissionlessly, can go and and deposit whatever tokens you specified for the initial basket in order to mint R tokens. So you don't need any capital to get it started. You just need an idea and a willingness to deploy, and probably an annoying amount of ETH in order to pay for that initial deployment. That'd probably be a little bit expensive. In terms of what you need to do, like how you would need to design it in order to incentivize sufficient RSR backing, basically what you need to think about as an R token creator, or if you're part of the governance process for an R token, is the question of, well, what amount of yield or return needs to be offered to RSR stakers in order for them to be attracted to come and stake, and how much value of staked RSR do we want for insurance relative to the outstanding value of the R token itself. So again, we can take a simple example. Let's say that there's $100 worth of R tokens, and let's say that you want to have 25% insurance, like that scenario we talked through where you had enough RSR to cover that 25% loss. Well, that means that you need $25 worth of RSR insurance if you have $100 in the R token. And so if you want to hit that point of having $25 worth of insurance, the way that you have to think about that is like, okay, well, what is the going rate for return on capital in crypto? Let's say it's 10% or 20% or whatever. You can take that information and say, okay, well, what is 10 or 20% of $25? So let's say it's 10% to make it easy to do the math. So 10% of $25 is $2.50. So it's like, okay, we need to offer $2.50 of annual revenue to RSR stakers in order to get $25 worth of RSR staked, earning that 10% yield per year. So you can actually work backwards and figure out, okay, this is how much, and we're talking in terms of absolute dollars right now because that's easy to think about, but you can think about it in terms of percentage of the R token value, right? So we're saying we need $2.50. Well, that's 2.5% of the total R token value. So there you can say, okay, we need to generate enough revenue in order to offer 2.5% of the R token value to RSR stakers, and that would get us 25% backing if crypto market participants are willing to stake for a 10% yield. So basically, I know that might have been like a little bit difficult to follow if you haven't thought about these kinds of numbers before, and this is something that I hope that we can publish some more detailed writing on, and maybe a video to help people understand that the way that math works. But basically, you can think about it pretty straightforwardly in terms of how much of an incentive do you need to offer in order to get X amount of RSR staked in order to have Y amount of insurance backing.
That was really helpful. That's cleared that up. Can I quickly ask a supplementary on, in terms of the user interface for all this? So, I mean, it can sound complicated when you're talking about it, when you read about it, but when I see that on an iPad or a laptop computer, have you thought through how simple you can make that for people?
Yeah, totally. So, so basically, well, let me just share a little bit more about UI in general. So, like any application on Ethereum, anyone can create a user interface for it. And so it may be the case that you end up being able to access staking and minting and redeeming and so on through many different interfaces, through existing wallets, through other dApps. People could program their own dApps that are just for reserve, or sort of generic interfaces that have started to allow you to use many different blockchain protocols, could end up integrating it. But to kick things off, there is an entity that is connected to the project that's developing a front end to start. And so that front end will contain all these basic features of minting and redeeming and staking and unstaking and so on. And so as an RSR holder, you would be able to go to that website and see, okay, if I stake my RSR, what would the staking returns be right now? And obviously that's a variable thing, because the amount of revenue that an R token generates can change over time, and the amount of RSR that's staked will change over time, and that revenue is split between the stakers. So the more people stake, the lower the revenue will be. The fewer people have staked so far, the higher the revenue will be. So you'll be able to go to an interface, on an iPad, although it's probably complicated to use MetaMask and so on an iPad, so maybe on your computer, and you'll be able to see what the marginal staking rewards would be and make a financial decision about, like, does that make sense? Do you want to take that risk in order to earn that income or not?
That's great. Thank you.
Yeah.
Thank you, Robin.
Good to speak to you.
Before we get to the next person, we have another question in the Twitter thread. Nevin, you recently tweeted that the version 1 of the protocol will include a system where the protocol will buy or swap to the RToken revenue to RSR, if I remember correctly. Alex is asking, how will the protocol handle the high gas fees of Ethereum when, for example, when market buying RSR or when increasing the staked RSR balance?
That's a great question, and probably if one of our engineers were on, they could give a more detailed answer. I talked to them about whether they should join, and we decided they should just keep working on implementing, because we're pretty focused on speed right now. The high-level answer is that we've looked for ways to make it so that those transactions can happen in bulk, so that it's not the case that each individual RSR staker needs to trigger a transaction over and over and over again. And so if I believe that that's the solution that we've landed on. So basically what this means is that there can be like a single transaction that somebody calls that ends up being called periodically, that basically makes those trades on behalf of everybody who's staked. And if you divide that up amongst everybody, then it ends up not really being very expensive. So that's the short answer to the question, is basically whenever, and this occurs not just with that one particular case. There's lots of cases in the protocol where trades need to happen or actions need to happen, and the engineers end up putting a lot of thought into, well, how do they sort of group those transactions as much as possible so that there's not like a high overall gas overhead. But I think that hasn't presented a barrier. I think that they've come up with a way of doing that looks like it's not going to be an issue.
Awesome, thank you. Hani, you're already a speaker. Are you here?
Yeah, I'm here.
Okay, go on.
So I have 3 main questions for you today. My first question is, I'm reading the documentation online, and it says that the R tokens will have a 1-to-1 correspondence with the assets in the basket that back them. I'm wondering how this would work with rebase tokens such as Ample, if you decided to use that as the asset that backs your R token.
That's a new one. That's a really interesting question. Well, the short answer is I don't know, because all of the R tokens that we've been contemplating don't involve tokens that rebase. We've thought about tokenized gold, like a Pax Gold, which has a transaction fee. But while the protocol is holding it, there's no transactions happening, so you don't really have to worry about that. So it's a good question. We'll probably think about that, and maybe we'll have an interesting idea about it. But for now, it's just not contemplated, so I don't know it would happen.
Well, hopefully you guys think about that, because I think there was a few DeFi protocols which had trouble with rebase tokens.
Yeah, it's totally true. And there's some decisions or some design decisions we've made in order to keep our protocol predictable. Like, we've thought about doing weirder things that would actually probably cause other DeFi protocols to break, and we've decided not to do that for that exact reason. It's like there's some basic assumptions that people tend to make about tokens, and if you break those assumptions, you can get cool properties, but it also makes it harder for other things to be built on top of it. So totally hear you on that.
My second question is if you guys are planning on deploying the contract for the R tokens on any other EVM compatible chains such as Arbitrum or Polygon or any of those other two or level 2 chains?
We're definitely interested in, we're like, our key interest is using a layer 2 for the transactability of the stablecoins themselves, because that's what's most relevant to the users that we are focused on serving. In terms of allowing for protocol actions like staking or unstaking RSR on layer 2s, that's something that we haven't thought through as much. It could be that that makes sense, or it could be that that's not necessary. I'm not actually sure. We classically have been most interested in ZK Sync as a layer 2 solution, given some of its properties. But we're watching, Optimism and Arbitrum and Polygon and seeing how they develop. And yeah, I think like many projects, we're sort of seeing what happens with network effects with these layer 2 solutions, and whether there end up being any security issues. And we're looking forward to the point where it's sort of clear enough to tell which makes sense to build on.
Yeah, that answers my question. And I have one last question. You guys compare yourselves to Uniswap. The reason being you guys leverage the factory contracts that are used on Uniswap as well.
Yep.
I'm wondering how committed you are to regarding censorship, because I know the Uniswap front end has been known in the past to censor certain coins deployed on there. How committed to that are you?
Well, I mean, the Reserve project was started in the US, and several of us are still in the US. We have, legal entity in the US. So I think we would be subject to similar pressures that the Uniswap founders would be subject to with respect to front ends. And so, if our primary company were to deploy a front end and then US regulators came and told us that we had to change something about it, we probably wouldn't have a choice but to do so. However, it is the case that the initial front end that's being deployed for the Reserve protocol isn't created by the main company behind Reserve. It's created by a different company that does some blockchain development stuff. So that could mean a slightly different dynamic than maybe Uniswap would deal with. But I think in the big picture, really the censorship resistance comes from the fact that anyone can easily build and deploy a UI. So even if we deploy a UI and the US government comes and says, hey, you have to completely turn this off, maybe we do that, but that doesn't really stop people from using the protocol, because anyone else anywhere in the world can deploy a UI. And so if there really is interest and demand to use the protocol, that will happen. And I think that that's what we've started to see with Uniswap, is many different UIs. Like a lot of the volume that goes through Uniswap doesn't go through the main UI. So so in that sense, even if we end up having to comply with the government request, it doesn't really, I think, change the dynamic in the long term in terms of people having access and being able to use all the features without any restriction.
Do you think that having a protocol where anyone can interact with the factory contract would create regulatory hurdles, since anyone can create their own R token?
It's a good question. I personally don't think so, because with open source software, anyone can create a copy and go deploy it themselves anyway. So making it a factory contract, essentially automates something that people could have done anyway. Our intention is for the source to be open. It's sort of important for the source to be open, for people to be able to look at it and analyze it and verify it. So because of that, really anyone could have gone and created R tokens themselves anyway. And all we're doing by making it a factory contract and, eventually probably making it so that it's easy to deploy it even in the UI, it's really just automating something people already could have done. So you know, who knows? Maybe a regulator someday would argue differently and say that, you know, we were actively facilitating an activity, and maybe that puts us in a different legal position. But as far as I can tell, it shouldn't be legally relevant.
Yeah, thanks for that. That answers my question. I look forward to the R tokens that people deploy using your contract.
Yeah, yeah, me too, me too.
Awesome. Thank you, Hani, for those great questions. Nevin, I was.
And
Go ahead.
I was just gonna say, Sinatra, I do have a few extra minutes, so like we could go over. It seems like there still are several more questions, so we could keep going for another like 20 minutes.
Okay.
If people want to start.
Awesome, awesome. I just want to also repeat that we are having a second Q&A at 5 p.m. PT. So if you don't get a chance to ask your question, you still have the second Q&A. And also both Q&As will be recorded and posted on our social media in case you want to re-listen to them. All right, Neve, are you here?
Yeah, I'm here. How are we doing? It's a quick question. Hi, Nevin, long-time follower. It's a quick question in relation to the Slow wallet. So originally it was going to be used partially for arbitrage. I just wanted to know how that's going to look with staking, and is it going to remain on the 4-week delay that you guys already had planned on the previous white paper?
Yeah, excellent question, and nice to meet you, by the way. I'm a fan of yours. Let's see. How do I explain this? Okay, this is not the answer you're looking for, because I'm not going to disclose the full details of our plan yet. And that's simply because I don't want to create confusion and speculation about this. What I will say on a high level is that we've designed and are finalizing an updated mechanism that is likely going to be more restrictive than the Slow wallet has been, to give RSR holders more predictability about possible increases to circulating supply. And it will also have more nuanced logic in terms of how it works, and that will relate to like governing the ways in which the project tokens can be used in staking and governance. And I'm really excited to explain that. I think that it's something that it's important for us to get exactly right and for the community to fully understand. But because like basically we still need to have like one more like 4 or 8 hour session where we like really think through everything in full detail and make sure that we're not getting one little piece wrong. Until we get to that point and have everything perfectly finalized, I'm going to keep quiet about the specific details just so that there isn't confusion. But relatively soon, we'll probably have like a whole like blog post and discussion to explain that in detail. And I hope that will satisfy, you know, anybody's concerns.
Excellent. Appreciate that. All right. Thanks a million. And remember, it's only 3 cents.
Thank you. All right. Jesse, are you here?
Yes, I'm here. Hi, Nevin. My question is about the staking capacity. What are the mechanisms for targeting the amount of RSR staked? Is it going to be sort of limited, or will it be based purely on supply and demand?
Sorry, I think my connection cut out for a second. Could you say that one more time?
Hi, my question is about the capacity of staking on a given R token. How will that target amount be achieved? Is it purely supply and demand, or are there parameters that the governance will target?
Sorry, I hate to do this. Can you say it one more time? I think that my connection is finally restored.
Okay, yeah, no problem. The question is about the capacity of the RSR staking on a given R token. How will that target be achieved? Is it purely supply and demand, or are there parameters that the R token will set?
Got it. Okay. All right. Sorry to make you repeat twice. And nice to meet you, by the way. So the answer is that there are parameters that can be tweaked in order to hit a particular staking target. So like we talked about in that example before, let's say that you want there to be, 25% of the RToken market cap in terms of value of staked RSR. The main parameter that you have to work with is the percentage of RToken revenue that goes to RSR stakers. So let's say that you only think you need 25% backing, but you actually have 50% backing with how much RSR is staked right now. Well, you could actually direct revenue away from RSR stakers to RToken holders, and that would reduce the incentive to stake, and so the amount of staked RSR might go down, but it will also increase the incentive to hold the RToken. So the total amount of RToken might increase as a result of that. Whereas in the opposite direction, let's say you only had 10% of the RToken value staked in terms of RSR, you could direct more of the revenue to RSR staking in order to increase that incentive and get closer to the goal of, say, 25%. So basically that's the main lever that the RToken governors have in order to control the demand for staking in order to get to a target backing that they had decided was appropriate.
Got it. Thank you. So quick follow-up. Do you see fairly active governance then in order to target that as a as a function of it?
That's a good question. I don't think it has to be that active because the exact backing percentage doesn't have to be like super exact. If it's like, it's not like you're using this to like stabilize the coin itself. And so if there's some amount of variation in terms of the percentage of backing that you have, that's okay as long as you're around the target or like a little bit above the target. So I don't think it's something where you're going to have to, tweak it back and forth all the time. It's probably more of a sort of slow process of like, okay, over the past few months, it's been like a little bit below, so let's bump it up a little bit. And then as long as it's above that target, then, there might just not be a reason to change for quite a while.
Got it. Thank you very much.
Yeah.
Thank you, Jesse. Marcin, are you here? Marcin, we can't hear you just yet. No, nothing yet. Why don't you check your app settings, Marcin, and we'll let Bouncy go first. Go ahead, Bouncy.
G'day, Nevin, and g'day to all future yacht holders in here. Just a question about the new staking protocol, mate. Is there a minimum or a maximum percent APY that is expected for the RTokens? And if there's not a maximum, are you worried about potential volatility in the APY?
What was the thing that you're asking if I would be worried about if there's no maximum?
Yeah, if there's no maximum, are you worried about people creating RTokens with high volatility that might cause, it could be an issue in the future?
I see. Okay, so the answer is there is no minimum or maximum. So the staking yield is just a function of it's a function of a few things: the amount of revenue that the RToken generates, the amount that is directed to RSR stakers of that revenue, and then the amount of RSR that has been staked so far, right? Where like you can imagine a scenario where if only a tiny amount of RSR, let's say no RSR has been staked, then if you go and you're the first one to stake RSR, you would get 100% of that revenue stream. So it could be like a ridiculous return. But then as more people stake, then the return would go down per person. But yeah, so there's no minimum and no maximum. And then on your other question, I think I get what you're asking. It's like, well, could people create RTokens that aren't really stable coins that are backed by other like much riskier things that generate lots of revenue, and then you could have much higher staking rewards, but also much higher risk? The answer is yes, that could happen. It's not really our intent, and so there's a bunch of little details about how the protocol is designed and optimized, which assume that the backing assets are relatively stable, because that's, you know, sort of what we're trying to accomplish here. And so I don't think that the reserve protocol is necessarily going to be well suited for like arbitrary token baskets in terms of like investment portfolios or something like that. But you know, it could be that like other developers take the RToken code base and tweak it in order to optimize it for that, and so it could end up being used for that in the future. Although that's not really what we're optimizing it for.
Yeah, that was my question. Wasn't, but you answered that correctly. Thanks for that, mate.
Okay. Yeah, you're welcome.
Thank you, Bouncy. Flamingo, it seems like you made it. Are you here?
Yeah, I'm here. First off, thanks, Nevin, for doing this. Really appreciate it. My question, which you kind of already answered since Neve basically asked it, but I'll go ahead and elaborate. Maybe you could give us some details. Do you envision a large or even all of the RSR locked in the slow wallet to be released eventually?
Well, I guess I should stick to my guns on not speaking about part of the detail before speaking about the entire mechanism, because I just don't want to cause confusion and speculation. So unfortunately, I'm just gonna not answer that for now. But basically, as soon as we have completely finalized the mechanism for how those project tokens will be held and deployed, then we'll describe that in full detail. And I do want to do that as soon as possible. It's always just a balancing act of like, you know, the time we put into that is time we don't put into other things. So we haven't quite gotten to finalizing that yet. But as soon as we do, I'll be excited to speak about that in full detail, so that's totally clear to people.
Great, thank you.
And it's a very legitimate question. I don't at all mind you guys asking that question. I wish I had the answer for you today. Just want to wait a little bit longer.
All right. Thank you, Nevin. There's one more person asking to request, so I would suggest, Nevin, if that's okay with you, one more question in this Q&A.
Yep, sounds good.
All right, Braden, are you here? We'll give him a second. Priceline, you're still muted at this moment.
Oh gosh, I've been talking the whole time.
Okay. There you go.
Funny. All right. So in terms of staking the reserve team's RSR on the DeFi dollar R token, which we call RS yield sometimes, do you have a monetary model in mind for how much the team is willing to stake initially in terms of percentage or dollar value? This question is going outside of the team's treasury that's being placed in the RS yield token market. Does that make sense?
Yeah, and this relates to the question that I just didn't answer, unfortunately, because the details are intertwined. I guess what I can say is that in the short term, the tokens that the project stakes will probably, like, that decision is honestly probably more driven by how it impacts governance than it is how it impacts the project's, you know, portion of yield that would come from the R token. So essentially, you know, when I talk about needing to finalize exactly how that's going to work, that mostly, like, we have a design worked out, but the reason why we haven't published that and committed to it is essentially that we have like another design session we need to go through to check all of our assumptions one more time about how it's going to work with governance, to make sure that we're not creating any sort of governance risk that's unnecessary, because the portion of project tokens that are staked will end up having an impact on the role that the project plays in governance at the beginning.
So it sounds like you would not risk your tokens because governance would be at risk if there was a default large enough to absorb your tokens.
No, although that is exactly the sort of consideration that would come up in the type of analysis that I'm talking about. So it's a good point. We will think about that. But the basic concern is more on the level of what fraction of governance power does do the project tokens hold? Because and so this is something I can explain, and this might help make sense of this. So the governance model that we're going with at the beginning is essentially the form of relatively simplistic token voting that we've actually spoken negatively about in the past. And we basically still have all the same negative views about it, but we ended up concluding that it is safe and appropriate to launch with that form of governance, as long as it's able to evolve over the course of time as the token ownership becomes more decentralized, and the sort of community becomes broader, and as like more people find out about RSV, and as the market cap gets larger. So because it's based on token voting, like the way that our governance is slated to work for that token that you're referring to, is that when you stake RSR, that token that you get in exchange for staking RSR that represents your staked RSR balance will be the token that is relevant for governance voting, for on-chain voting participation. And what that does is it makes it so that it's not the case that all RSR holders govern each individual R token. Only the RSR holders who have chosen to stake on that R token are able to vote and govern that R token. So you basically, you have to have skin in the game in order to participate in that governance process. What that means is that for any particular R token, how much governance power we do or don't have doesn't have to do just with how much RSR the project holds. It has to do with how much RSR the project has staked on that particular R token. And so that's part of this plan that we're finalizing in terms of how much we want to stake, how much we want to be cryptographically allowed to stake, in order to have a role in governance that's significant, but not too significant. It's actually, I think, a negative thing if we have too much governance power. And so defining exactly where that line should be is part of the final stage of defining exactly how the contract will work that will hold and govern how the project tokens can be used.
So it sounds like there is a fundamental limit to an address in the total amount of RSR that it can stake on a single R token?
Probably yes, but again, let's try not to speculate about it too much, because I want it to be understood as clearly as possible once that full mechanism is published, which will hopefully be quite soon.
Thank you very much.
Yeah, thank you. So yeah, and thank you, Sinatra, for hosting this, and thanks everyone for participating. And like Sinatra mentioned, we decided to, this is an experiment, we decided to do 2 of these just because of different time zones and different availability. So we'll hop back on at 5 p.m. Pacific. We'll have 1 hour available at that point. I guess this announcement isn't relevant to all of you because you all obviously were here. But if there's anyone who mentions that they missed it and wishes they hadn't, you can let them know that there's another time today at 5 p.m. Pacific.
Yeah, and I also want to emphasize that this session will be or has been recorded, and we'll be uploading it to our social media. So if you want to listen to it again, make sure to follow Reserve Protocol on Twitter. And so yeah, and we'll also make another post for the second Q&A later today, which includes your time zone, so you know exactly when it is. All right, thank you everyone. Thank you, Nevin, for joining in, and maybe see you at the next Q&A. Thank you.
All right, ciao.